Roger. Had McMillian Shakesphere for a little while. It owes me nothing. It's about $4.30 where I bought it. What does he think on the long term on that? Thanks very much.
There was a dip in the price, obviously, because there was some fear around the Henry tax review. I was on this program saying that I was quite happy to sit aside. I'd bought the stock previously and sold it at close to $4. It dipped all the way down to $3 or a little bit less even, and it's now back above, well above that $4 mark, 10% above it, $4.40. So I've been happy to sit aside until there was some clarity around that Henry tax review issue. Now that is passed, I can say this. The value of this particular company is rising substantially over the next couple of years, and I've got a value of $6.01 in 2011 and $6.19 in 2012. It's a great business. It's one of my A1 businesses, you know, and I've talked about it many times in the past, and I think it's a terrific business. The issue for it, of course, is if the government, if the Henry tax review came out with a worst case scenario for McMillian Shakesphere, that worst case scenario would be very detrimental to the company. They could lose half their business. That hasn't happened, and the long-term prospects for this business remain good. So I've missed 40 cents or something like that. I'm nonplussed about that, because the intrinsic value is almost $2 higher than where the share price is today.
Mel, he's from Surrey Hills. Welcome, Mel. What's your question for the panel tonight?
Oh, hi there. Thanks for taking my call. It's about Australian Worldwide Explorations, a stock code AWE. What would have to happen for either or both of the panellists to buy it at the moment? It sort of looks cheap looking at the charts, but what do they think?
Well, it's certainly had a big fall. I'll probably go to you on this one, Tolly. Is this one that's likely to... Well, if we spoke about it earlier, but is this one got any kind of upside at all?
Short-term momentum indicators are definitely giving us a bullish divergence, which basically are suggesting we're going to get a bouncy. But from a wave structure point of view, I would dare say that it needs to go down and retest that $1.70 low of October 2008. So just be a bit patient with that one, but it's trying to bottom, and there's definitely some bullish divergences in the short term.
I can give you an indication. You started the business off, let's say theoretically, in the year 2000, which is 10 years ago, with $61 million. You've added another $710 million injected into the business over the last 10 years, and you've left in. You've also left in retained earnings of $312 million. So there's about $1 billion that you've invested in this business. That's a lot of equity, but you're generating a return of only about 14% or thereabouts, which is modest, but you know, it's not going to shoot the lights out. The big problem is the number of shares on issue, and that means that the intrinsic value of this company is so substantially below the share price that it's embarrassing. I've got an intrinsic value of 44 cents going to 49 cents in 2012, and it's trading obviously substantially above that. You know, for anyone who owns the shares, I hope Tully's right. You know, and that bullish convergence starts to work. Out of almost 1,900 companies that I follow, there are...
You better write down those 4.
Yeah, we'll talk about them. I'm sure someone will raise them in their questions throughout. You know, I can only find 4 things that are good quality and cheap. So, you know, I can't invent other things.
No. What's your question for the panel tonight, Shane?
Yeah, how you going, guys?
G'day.
Now, the share I've been following is Nido Petroleum. The code is NDO. Now, I'd really appreciate opinion of Tolly and Roger. And also ask Roger how long till his book comes out. I'm still waiting.
Chance to get yourself a nice plug for today.
Yeah, you know, I talk about intrinsic values. I talk about intrinsic values a lot on this program and elsewhere, and what I've done is put together a guidebook so everyone can calculate the intrinsic values themselves. The book went to the printers. It went to the printers last Friday. So it's in the process of being printed right now. If I'm only printing as many copies for those people who have pre-registered, so I'm not in the business of book publishing, so I'm printing enough copies for the people who've pre-registered, and if people want to pre-register, they just go to rogermontgomery.com, they can do it.
You should give Shane a free one for the publicity he's giving you tonight.
Yeah, appreciate the question, Shane. Thanks very much, mate.
And Nido?
Nido. Okay, so Nido is one of those businesses, and you'll see from that share price action there. I've got a view that over long periods of time, share prices tend to track intrinsic value, and if the share price has done nothing over a long period of time, then generally you'll find that the same thing's true of intrinsic value. And because this business actually has very mixed historical performance and its future performance is mixed, then look, the intrinsic value changes from a couple of cents to nothing, which I know people who own the shares don't want to hear, but that's my take on it. It's just, for me, it's just not investment grade. There might be speculative interest in it, and I appreciate that, but I'm in the business of investing, not speculating, and in reality, this for me is just not, it's not investment grade.
So there's better places to invest.
To give you some perspective, let's imagine for a moment it's not a stock trading on the market, but it's a business that the three of us are going to invest in and run. Well, my question to you would be, well, how would you feel if we start 10 years ago with $9 million and we subsequently add another $112 million over the last 10 years, and we're getting a return that's negative? We're losing money. We haven't made any money yet, really, on an aggregate basis in that decade. I know anyone looking at it as a business would say, well, that doesn't sound like a great business. I should have bought a Baker's Delight franchise or an Oporto franchise or something like that. I would have made more money and put less in. Because it's a stock and it trades on the market, people are speculating about its prospects. They might be right. They might make a lot of money, but as a business investment, it doesn't seem to meet the criteria.
Wonderful. Hi, Piers. Thanks for waiting. And what's your question for tonight?
Thank you. I'd like us to ask about Gunns, the timber company in Tasmania, who currently the price really has dropped a long way because they are also waiting on finance for the new pulp mill. What I'd like to know, Roger, obviously the intrinsic value, do you think it's a well-run company, and do you think that the management is good there?
Well, let's talk about the business to begin with. Let me give you some facts. Earnings per share for this company have fallen from 30 cents in 2004, 30 cents per share, to 8 cents in 2009. The forecast for this year is 1 cent. Earnings per share growing to 3 cents in 2011 and 6 cents in 2012. The result of those declines, generally you don't want to buy businesses whose intrinsic value, whose earnings are declining. You want to buy businesses with bright prospects for their earnings. The intrinsic value has tracked those earnings lower, and in fact the intrinsic value for this business is about 6 cents at the moment. 8 cents at the moment, rising to 23 cents in 2011 and 40 cents in 2012. Now that compares reasonably well with the current price, but it's not at a huge discount to intrinsic value. Most importantly, the business doesn't get a great score for me. It doesn't get an investment grade quality score. Mm-hmm. That's not to say that won't turn around. It could very well turn around, but based on the facts that I have in front of me, it's not an A grade business by any stretch. From my perspective, it's high risk because it's not a high quality business based on its historical fundamental information. But its prospects, the information that I've got, the prospects are that its value should improve. Now, its intrinsic value, to give you some idea, its intrinsic value's fallen from $4.21 in 2004 all the way down to 8 cents currently. That's the intrinsic value, not the price. What you'll notice is the price has generally tracked the intrinsic value lower. It's followed it all the way down. And Benjamin Graham, who was Warren Buffett's mentor, said that was the case. In the long run, the market's a voting. In the short run, the market's a voting machine, but in the long run, it's a weighing machine. So in the long run, price tends to follow value. I should just say, it's interesting that you talk about the sort of this capitulation sell-off, this panic sell-off that's occurred, and there's a big volume spike. Obviously, that volume spike means there are buyers. So there are some people who have obviously thought about what I'm talking about here in terms of the rising intrinsic value over the next few years. What I'd like to do is buy stocks at a big discount. The only other issue I've got, of course, is that I want to see the quality of this business improve, and at the moment, you know, it's not investment grade.